We're just days away from something that could shake the economy, rattle the markets, and even affect your day to day life. I'm talking about a potential government shutdown. The White House is warning of serious consequences, and federal workers are already being told to prepare for possible furloughs. That's right, families could feel the squeeze in ways most people have never seen before. Today, we need to break down exactly what's happening, why this shutdown might take place, and most importantly, what it actually means for you and your money. Because while there's a lot of noise out there, a lot of the key details are being skipped over. And by the time you finish this video, you'll know exactly where we stand and what's coming next. But really quick, before we dive in, if you appreciate videos like this, where we cut through the headlines and focus on what matters, it would mean a lot if you hit that like button and subscribe. It's totally free and helps out the channel. Now, let's get into it. So first up, let's answer the big question. What exactly is a government shutdown and why should you even care? At the core, it all comes down to something you've probably heard tossed around in the news: the debt ceiling. In plain English, this is the maximum amount of money the US government is legally allowed to spend to keep everything running. From Social Security, to Medicare, to Medicaid, to military pay, to tax refunds, and even interest payments on the trillions of dollars we already owe. When you see a national debt number like $37 trillion, that didn't just appear out of nowhere. It's the result of budgets being set intentionally by lawmakers over decades. And every year, those budgets have to be revisited, approved, and reallocated. Now, here's where things get messy. Normally, by the end of September, Congress passes a budget that funds the government for the following year. But if they can't reach an agreement by September 30th, then by law, specifically the Anti-Deficiency Act of 1884, the government literally has to stop spending money it hasn't been given approval for. And that's what we call a government shutdown. Sounds ridiculous, right? But it's real. And the consequences ripple out quickly. Non-essential services get paused, federal workers can be furloughed, and agencies that collect critical data like jobs reports and inflation numbers can't release the information the Federal Reserve relies on to make huge decisions like interest rate cuts or hikes. And considering the Fed's next meeting is November 7th, the timing couldn't be worse. Okay, so why is this happening this time? Well, government spending runs on an annual cycle, and ideally, everyone in Washington comes together, approves a plan, and the government stays open. In practice, though, politics. In 2025, Republicans hold majorities in both the House and Senate. On paper, that should make passing a budget easier. But here's the catch. Even within the Republican Party, there's disagreement over what should be funded and what shouldn't. Some want deep spending cuts, others want certain programs preserved, and without unity, nothing moves forwards. At the same time, Democrats are pushing for their own priorities, like protecting subsidies under the Affordable Care Act, preserving Medicaid, and maintaining social programs. And in order to win votes, both sides are basically holding their ground. So what you end up with is a giant game of chicken. Republicans saying, we'll fund the government, but not if it means spending more EK. While Democrats counter, we'll only agree if these protections and programs stay in place. And even if, big if, a deal passes in the House, it still has to move through the Senate where more negotiation happens and finally reach the president's desk. That entire back and forth has to be done in literally a matter of days, otherwise lights out. So, what happens if US actually goes into a shutdown? First, federal employees like active duty military and law enforcement would be expected to keep working but without pay until funds are approved. Agencies like FEMA could see their disaster relief budgets drained. The TSA, FDA, and others would be affected too. Goldman Sachs has estimated that every week the government is shut down shaves about 0.2 percentage points off GDP growth. That's not catastrophic in the short run, but it adds up quickly if the shutdown drags on. The good news is that once the government reopens, that growth usually comes back. Another risk? The release of critical economic data, jobs reports, CPI, inflation data could be delayed. And the Fed depends on this data to set interest rates. If they don't have the numbers, they're basically flying blind. Now, realistically, a shutdown would have to last at least 3 or 4 weeks before this data delay becomes a real issue. But even a short shutdown sends a bad signal to investors, and that brings us to the markets. Now, let's talk about how this affects the stock market and your investments. The truth is, history shows it's a mixed bag. For example, the worst shutdown in terms of market impact was in the 1970s, when stocks fell nearly 4%. But in late 2018, During the longest shutdown in history, over a month, the markets actually rallied more than 13%. So it doesn't always line up the way you'd think. In fact, analysts at Barron's note that the broader market usually shrugs these things off. Defense contractors, healthcare companies, and certain government-dependent businesses might get hit directly. But overall, corporate earnings, interest rates, and economic growth trends matter more. Here's an interesting stat. Since 1976, we've had over 20 shutdowns. The longest was 34 days in 2018 to 2019. The average length, just 8 days. And during those periods, the S&P 500 was higher half the time and lower the other half. Average return, 0. Even more surprising, a recent study found that during shutdowns, the market actually ticks up on average by 0.1%. And in the 12 months following shutdowns, markets tend to perform very well. After the 2018 shutdown, the S&P gained 26% over the following year. After the 2013 shutdown, nearly 20%. Since 1980, the average gain in the 12 months after shutdown is almost 17%. So, from an investing standpoint, history suggests a shutdown isn't necessarily a disaster. The bigger issue is the signal it sends that US government is divided, dysfunctional, and unable to get its act together. That undermines confidence both internally and externally. Here's where things get even more serious. Beyond the day-to-day drama of a shutdown, there's another problem that doesn't get enough attention. The U.S. credit rating. See, the U.S. borrows money by issuing treasuries. Investors buy them because historically, the U.S. has been the safest borrower in the world. We've always paid back our debts on time. That reputation is why the U.S. dollar is the world's reserve currency. But earlier this year, in May, Moody's downgraded the U.S. outlook from AAA to AA1. Why? Because the debt is growing at an unsustainable pace. Entitlement spending is rising, revenues are flat, and deficits are ballooning. They project that by 2035, interest payments alone will make up 30% of the federal budget. Think about that. Imagine you make $100,000 a year and $30,000 of it goes just to paying credit card interest. That's essentially where the U.S. is headed. So, while a short shutdown won't cause the U.S. to default on debt, that's not happening. It does highlight a bigger issue: political gridlock and weak fiscal discipline. Moody's has already warned that persistent deficits and higher interest costs could put even more pressure on our credit rating in the years ahead. The longer these fights drag on, the weaker America looks compared to other countries, and that erodes investor confidence. So, where does all of this leave us? In my view, the most likely scenario is that right at the last possible moment, Congress agrees to some kind of temporary funding measure, something that keeps the government running for a few weeks, buys them time, and kicks the can down the road. That's usually how this plays out. A full shutdown benefits nobody. It's bad optics, it hurts federal workers, and it doesn't actually solve the underlying disagreements. More than anything, this whole process is political theater. For you and me, the best thing you can do is prepare like you always should. Keep an emergency fund, live below your means, and build multiple streams of income. Because while you can't control what Congress does with trillions of dollars, you can control your own financial decisions. So don't panic. A shutdown isn't the end of the world, but it is a reminder of how fragile confidence can be, and why being proactive with your money is more important than ever. And with that, thank you so much for watching. If you found this video helpful, don't forget to hit that like button, subscribe, and I'll keep you posted as this story develops. Appreciate you guys, and until next time.